All right. Hey, good morning. Welcome. I know it's busy and it's harvest, so it's difficult for most people to dial in. So we'll go ahead and jump in. I'll hit the record button and we'll try to keep the recording as clean as possible. So if you've got questions, use the chat function and I'll try to get them answered. And we'll just jump right into it. Um, lots of lots of volatility and lots of unknowns, right? in a so I think in a normal market we have we have one or two major variables that could come into play. I mean, in a normal market, we're worried about our supply and we're worried about our exports and we're just kind of worried about a few things and if any of those events trigger, then we can see a move, 2, 3, 4% in the marketplace. I think what we're dealing with now is a situation where we have about five different variables that could result in a move of 10 or 15% in the market. So the amount of volatility is just going to keep increasing, right? So what are those variables? Well, we have our supply variable. That's a complete unknown at this time, right? We're getting some yield reports, but you can hear yield reports that are way above expectations, and you can hear yield reports that are below expectations. So we don't have a really good feel yet for the size of the crop. We don't have a good feel for demand. We've been seeing oil implode for the last several weeks. Oil's dropped from 110 to 79 this morning. It's been as low as 75. And so the volatility there is creating uncertainty all over the corn market because we use so much corn for ethanol, right? The fluctuations, the correlation there is almost 80%. So as oil goes, so goes corn, for the most part. And then we have all of the macroeconomic stuff that's being floated around with the central banks raising interest rates. This morning, all over the news is the Central Bank of England in complete panic mode because they're having to save. They're basically having to bail out their pension funds because the pension funds all over the world have been acquiring consumer debt, which in the face of rising inflation has surged to an all-time high, and the default rates are starting to tick up. And so the pension funds are having margin calls, and they can't meet them. So the banks are starting to step in, and that's a massive number. When you're dealing with those dollars, you're not talking about billions; you're talking about trillions of dollars. I read a statistic yesterday that the bond market is like $180 trillion now, and equities are like 140. And then the currency fluctuations that are happening are over $4 quadrillion, which is just an unfathomable number. So the amount of money that's being made and lost by the currency fluctuations is staggering, and it's being rippled all over the place. So honestly, corn, and I've got corn up in front of us here, has held up unbelievably well in the face of an oil market that has completely collapsed and in the face of a currency that has just screamed higher. So if you compare our corn values globally to the corn values in Ukraine and the corn values in Brazil, right? Because those are the three places where China could normally come get corn. If you compare our values, both Ukraine and Brazil are approximately $1 cheaper per bushel than what they would have to pay at the U.S. Gulf. Now, why would we do that? Why would we let our market be that far out of the money? Well, I believe it's because of stability. We know that our system is functional. We know that we can deliver fast and reliable product, and we know that we can deliver it on time. And I think that's in our market is priced in a premium to that because you pay for the service. And so our market's been reluctant to give that up because of the instability in Russia, which could just explode overnight, right? that's billions of bushels of corn that China could have to come over here. Now, on top of that, you have dryness and weather concerns in South America. Now, I think it's way too early to decrease the size of their crop, but the trade's on edge because if they get tight, we're already really tight just on our own. We're seeing basis levels in the interior here at all-time highs or right at them. We've sold a lot of $8 cash corn right out of the field this harvest, and that's unimaginable to get $1.30, $1.35 over December corn at harvest. That's just amazing. So the balance sheet here is really tight, and if others want to come and get it, then they should have to pay up for it. So that's why corn's been so resilient. But let's look at these technicals here, because corn is really on the verge of a large move, and it could really go either way. Now, I want to spend a few minutes and I want to talk about these numbers right here, because these numbers tell us something significant. What these are is an automated Elliott wave indicator written by Tom DeMark. Okay, there's no subjectivity to these numbers. It's completely mathematically driven. If you follow Elliott waves, they're great. They're really, really cool to look at, and the theory behind them is fascinating. But the naysayers all complain about the subjectivity behind them, because you're constantly having to rewrite your counts based on market action. And that's fine, but we're all human, and so we all fall into an emotional tidbit where we label and look for wave counts that fit our narrative. Well, you can't do that with this indicator, and because of that, it always plots a blue wave count and a red wave count. Blue wave counts unfold in 5 waves to the upside. Okay, so you go 1, 2, 3, 4, 5, and red ones unfold the opposite. They unfold to the downside. So DeMark is counting this as a 1-2, which the next most probable move off of this count is lower, but it's also counting this recent action as a 2, implying higher prices. So we are completely caught in the middle, which is why the market is so goosey and choppy. It's why we're seeing big rallies and then they just get sold, because it doesn't know which count it should be in. And so one of the things that we're using to help us decide which count wins and which move is most likely are a couple of things. First of all are these trend lines. Okay, so if you take a trend line from the summer high to the first intermediate high, boom, you've got a trend line, and we've run into some resistance. Same back here. You take it from the low up, and we've formed what now looks like a wedge. So prices have consolidated inside this wedge, and they're nearing its endpoint. Now, recently, what we have is we've developed this trend channel. And what Elliotticians like to do with trend channels to decide what wave count that they're in is you snap a line from the origin of 1 to the end of 2, and then the intermediate piece, which would be the extreme of 1, you snap a parallel line to it. So these 2 peaks set the slope, and then this one sets the lower boundary line. And if price breaks out the lower boundary line, it would imply and suggest that this red count is the one that's operative. If it holds this lower boundary line, it would imply that the blue count is operative, and we might explode up out of here. So remember, the catalysts are there for us to explode either way, right? There's so many catalysts that could be in either extremely bearish or extremely bullish, and so the market's caught, and we're sitting right at the apex of 2 totally separate analysis: this long trend, this long wedge, and this Elliott trend channel, coupled with Elliott counts that are caught in the middle. One of these 2 is going to win, and this channel is going to help us explain which one it is. This morning we've had a breakout down to the downside. Now let's look at soybeans, because they have a very similar setup. Okay, except for the bean count is even a little bit more bearish, because what follows a B and a 2 is a 3 and a C, which would imply a move all the way back down to $13 in soybeans. Now, let's look at our trend channels. We've got the trend channel established here, and we have broken out at the bottom side of it, and we've rallied back to it this morning on the Bank of England news, and but so far we've held it. I don't know if we'll trade back into it or not and see some sort of exuberant action like we got yesterday. Certainly could happen. But I think it's really telling that this bar right here is the last report day where we just exploded higher because the USDA trimmed the number of planted acres, and they also trimmed the yield by 1.5 bushel an acre. So that was a big bullish supply shock, and we have now taken it completely out, and we're trading right at the open of where that report came out. This is the 200-day moving average. This is the 100-day. We've given it all up in the face of really bullish fundamental news. Now, if this does in fact close below this trend line and this trend channel line, then I think you have to look for an acceleration down to 1370, probably 1330 at a minimum, and very likely a test of 13 if that continues. So the most likely and most probable move in soybeans is lower. Now, the market's got a little jittery here this morning based on the news coming out of England, because it would imply that the Feds have created a bigger problem by trying to raise interest rates, and that they need to go back to quantitative easing and actually pump more supply into the system, which is inflationary, right? So that's got these markets bid. And on Friday, we have a stocks report coming out that is expected to show tighter stocks than what the USDA had previously said for both beans and corn. And that makes sense to us because basis levels have been so strong. That tells us stocks are tight, and that they're not ample. But we'll just have to see what they say, and price action will be our guide. If we don't break out the bottom side of this trend channel, and we start to rally, we're probably going to come test the top side of it all the way back up at 1469, and possibly even higher. And if we are tighter and we do go back to inflation, then we're going to new highs. I mean, these markets are going to move an extreme amount, whichever way this macro situation resolves itself. And I think we just have to make sure that we're aware that these setups count for $3 in soybeans either way, out the top or the bottom. How do you do that? Well, a couple of different ways. One is you take the extreme of 1584 and you take it all the way down to 1288, right? And you just double it. So, and you double it from the top. So it counts at least $3 both directions. You double it from the bottom, you double it from the top, and that's the extent and quantity of your move. Corn, same exact situation, right? We're looking at a $1.80 move up or a $1.80 down, either way out of this setup. That also coincides with Fibonacci extensions and targets off of these wave counts, which I've got marked down here. This is why we're fully hedged coming into this. We've got upside open, but we want that downside gone because it's too much risk for us to carry in such an uncertain and unknown environment. Now, let's look at Kansas City wheat. Kansas City wheat has been extremely difficult to trade. Get it to a daily chart here. It's been extremely tough. But if you look at this little trend channel, okay, it's in a 1-2 here as well. So we are either continuing to work up in a wave 1, or we're going to roll this thing over and come take out the lows. Couple days ago, it certainly looked like we were going to roll over, but what ended up transpiring is the development of this trend channel. And this trend channel so far is corrective, which would tell us that what we're actually working is a blue 2, and then the next most likely move is higher. We might get that sooner rather than later if the uncertainty and instability continues to come. I said that corn was $1 more expensive than our competition in Ukraine and in South America, wheat is like $1.80 higher than any other than Russian origin wheat. So wheat is kind of caught between we're way overvalued in the world, but we're holding these values because our supplies are tight, our weather's terrible, we're in extreme drought, and the weather's terrible in the South too, into South America. So wheat is really kind of having to hold that premium in for the same reason that corn is that if the world's unstable, we're the go-to. We're the ones that they have to come buy from. So that's why we've been so bid and so reluctant to trade lower. Where wheat goes from here is absolute crapshoot. Nobody knows. We don't know if we're worth $20, and we don't know if we're need to go back down and test the cost of production down at five. We really don't have any idea because of the instability coming out of Europe. And the only thing that's going to tell us are these charts. So if you look at our cloud system, and I'm going to jump through a couple of time frames here, we really like these clouds because they give us direction. If we're above them, we're bullish. If we're below them, we're bearish. And if we're in the cloud, we're neutral, which is exactly what this is telling us here today. I do think it's significant that we're finding support up into this area right in here, right inside the cloud. I think that that's significant and probably leans more bullish than bearish, but it's not enough to give a strong conviction and enough for us to take a position. So if we get more granular here and drop this down to a 4-hour chart, you can see that we're tracing 1-2s and 2s. We've got a 1 and a 2 here, and we're right on top of our cloud. So the 4-hour is maybe a little bit more bullish than bearish, but that can certainly change real quick if we just trade back lower, because now we're working 3 downs, which would count much lower. So wheat is absolutely difficult to trade, and it's kind of in no man's land, which is why we're fairly uncertain what's going to happen with wheat. You go to a 60-minute chart, you get no more clarity than what we had prior. You're in 1-2 counts again, which is implying an extreme move either way, right? You're either going to get a 3 up or you're going to get a 3 down, and you're right inside the 1-hour cloud. So wheat's point of indecision is as extreme as you can make it. And we can actually draw 2 trend channels here. We can draw a trend channel from this apex or the origin here of 1, snap it to the completion of 2, and we can snap it up to here. And now you have 2 trend channels competing for wheat's next most likely direction. And there's no way to predict which way that's going to resolve itself. So I think what you're going to see is as it breaks the upper boundary line of this trend line and the lower boundary line of this one, you're just going to see it start to accelerate. Now the problem is that that's a dollar range. And so it's just trapped in no man's land. And the dollar range makes sense when you look at our daily cloud because it ranges from 10 to 850. It's $1.50. So wheat is just absolutely in no man's land, which tells me I think we're going to chop sideways until we get closer to the edge of it. I guess that's the conclusion. I know that's really hard to follow, but these are really hard markets to trade because there's so much instability in them. So we're going to continue to stay hedged to the downside. We're gonna be real quick to make sure our upside is wide open as we come out of the tops of these things, but we've just got to keep giving them time to digest and time to trade and time for us time for them to work out what they want to do. All right, that is 19 minutes. I'm going to wrap it up. As always, there is significant risk in trading futures and options, and you should only do so in light of your own financial condition. If you have questions, please call us, and we'll be happy to work through any situation that you're looking at. I hope you guys have a great week. We will talk to you next Wednesday.